If you have a tax-deferred retirement account, eventually in your life, required minimum distributions will be a factor. At age 73 or 75, depending on when you were born, the IRS will require you to begin pulling money out of those accounts so they can collect income tax on those distributions. Now, this may not be a problem if you actually need that money to live on, but if you don't need the money, it creates an unnecessary tax burden that you'd probably prefer to avoid. In this video, we'll talk about 7 ways to limit the impact of RMDs on your retirement portfolio. Now, before we move on to the 7 ways to reduce RMDs, let's just do a quick refresh. We already talked about RMDs are just a fact of life that comes with a tax-deferred account. This could be in a 401k, thrift savings plan, a 457, a 403b, a traditional IRA, any of those. Basically, a required minimum distribution is going to require that you begin removing money from the account at age 73 or 75. If you turn 73 before the year 2033, that'll be the age that you begin making RMDs. After 2033, age 75 will be the RMD age. Now, to calculate your RMD amount, you'll take the balance of whatever tax-deferred accounts you have on December 31st at the end of the year. You'll divide that number using a divisor in the Uniform Lifetime Table, which is on the IRS's website. The product of dividing that number into your account balance will give you an RMD number that you have to remove from the account before the end of the next year or December 31st of the following year. If you fail to remove that RMD, you will pay a 25% penalty on that amount each and every year you fail to remove the money from the account. Now, RMDs have moved quite a bit over the years. Prior to 2019, RMD age was 70 and a half. Then with the Secure Act, we moved that up to 72. Then with Secure 2.0, the age moved to 73. And finally, in 2033, it will move back to age 75. At this point, I would like to issue a special thanks to Congress and the IRS for making this so simple to follow. In any event, you may want to reduce or eliminate RMDs altogether. Let's walk through 7 ways you can make that happen. All right, number 1 is you can just keep working. The IRS does not require you to make RMDs from accounts in an employer-sponsored plan for an employer that you're still working for. Notice this only applies to your current job. It doesn't apply to any old 401ks, 403bs, 457s, or other tax-deferred accounts. So you'll still have to pay RMDs at your normal age on those unless you roll the account balances from those old accounts into your current 401k or 403b or whatever your employer-sponsored plan is. That way it'll be sheltered from RMDs and you won't have to take them. Now, while this strategy will delay your RMDs, it doesn't eliminate them altogether. So let's say you're age 75, you're supposed to be taking RMDs, but you're still working, and you work until 77 or 78. Well, then you'll just pick up in the Uniform Lifetime Table at that age. Your divisor will be larger, and the amount you pull out in that first year will actually be higher than it would have been when you started RMDs. So it's not as if you get to put off Uncle Sam forever. He does catch up to you, but you can delay it a bit. Number 2 is to start withdrawing at age 59 and a half. Now, age 59 and a half is the age at which you can begin making qualified withdrawals from IRAs, 401ks, and other tax-deferred accounts without any early withdrawal penalties. So between age 59 and a half and age 73 or 75, or whenever you take RMDs, you can begin to pull money out of those accounts, thus reducing your account balance and the subsequent RMDs. One notable exception to the age 59 and a half rule is the rule of 55. And it basically says that for an employer-sponsored retirement plan like a 401k, you can begin making withdrawals when you retire from that employer beginning as early as age 55. Once again, this only applies to your current employer, and it only applies if you retire from that employer at age 55 or later. We have more about the rule of 55 and other ways you can tap your retirement accounts early. We'll put a link to that in the description below, and why not overhead. Number 3, convert to a Roth IRA or Roth 401k. Now, the thing about RMDs is they only apply to tax-deferred accounts. Roth-type accounts are funded with after-tax dollars, so they've already been taxed, and the withdrawals from those accounts are completely tax-free. So if you put money into a Roth account, not only is there no more tax burden, they're not subject to RMDs at all. Now, any conversions you make from a traditional account to a Roth will incur an income tax on that conversion, but again, if you spread this out over years leading up to RMD age, you can limit the amount of tax you end up paying on that conversion. This is especially useful in years where your income will be relatively low and your marginal tax bracket will be low as well. Number 4 is to invest conservatively. Most people have an asset allocation of stocks to bonds within a retirement portfolio. 60-40 of stocks to bonds is the most common type, but really it could be anything based on your strategy. The idea here is to hold the higher growth piece or the stock side in your Roth accounts and the slower growing part in your traditional accounts. And really all that's going to do is keep the balance of your traditional IRA probably a little lower than the Roth by having more conservative investments in the traditional side. And as a result, you can maintain your current asset allocation while slowing the growth of the traditional side of your portfolio. Now, I want to clarify, this comes after your asset allocation strategy. You don't adjust your asset allocation strategy in order to save a few dollars on taxes. That'd be penny wise and pound foolish. In other words, if you have a lot of money in a Roth, say 90% of your retirement account is in a Roth, you're not going to all of a sudden invest 90% in stocks and the other 10% in bonds. It's on the traditional side. Keep the asset allocation you have. Just make sure that as much as you can, put the more aggressive growth type stuff on the Roth side, and the more conservative, slower growing stuff on the traditional side. Number 5, make a qualified charitable distribution. Now, qualified charitable distributions are a really handy way to reduce or eliminate RMDs altogether. And really what a qualified charitable distribution is just redirecting your RMD to a charity instead of to yourself. That's because any gifts you make to charity directly from your account reduce your RMD on a dollar for dollar basis. So for example, let's say your RMD is $30,000 and you'd rather donate that to a charity than receive the money yourself. By using a QCD, you can send that money directly to the charity and it counts as your RMD for the year. This is a really great tool for folks who are charitably minded, or maybe you give regularly like you're a tither or something like that. There are some guidelines to this. First, $100,000 is the maximum QCD that you could make in the year 2023, though after this year that amount will adjust with inflation. You can't make a qualified charitable distribution from a 401k either, but you can roll a 401k to an IRA and do the QCD from there. Finally, QCDs must be made directly from your account custodian to the charity of choice. You cannot handle the money. If the money goes through you, it counts as a distribution and you lose the opportunity to do the qualified charitable distribution. One last little quirk. We talked earlier about the age for RMDs moving up from 70.5 to 72 to 73 to 75. Well, the age for QCDs never moved. You have to be 70.5 to begin making qualified charitable distributions, but you don't have to wait till RMD age. So it's possible to make qualified charitable distributions when you're 70.5 and then not have to take RMDs until you're 73. Now, you don't exactly get the same tax benefit in that year that you make the QCD if you do it before RMD age, because you can't reduce your RMD if you're not required to make one. But it can effectively reduce the total balance of your tax-deferred accounts before you reach RMD age. Number 6, purchase a qualified longevity annuity contract. A QLAC is a deferred income annuity that is not subject to RMDs. By purchasing one, you effectively convert tax-deferred savings into an income stream while also reducing the amount you'll owe in RMDs. A QLAC provides income at a predetermined age, but there is no death benefit. That means if you pass away before you begin collecting income from the annuity, the insurance company gets to keep everything. The maximum amount you can use to purchase a QLAC in 2023 is $200,000, and you must begin taking distributions no later than age 85. Number 7 is plan ahead. RMDs create a potential tax time bomb of sorts in retirement accounts. And in almost every strategy we talked about today, advanced planning is required. The good news is RMDs shouldn't surprise you in retirement, so there's time to account for them and mitigate them if you begin planning today. I highly recommend that you begin forecasting how much you need or expect to spend in retirement no matter what age you are, and you should also forecast how much you expect your RMDs to be. Typically the first year you're required to withdraw around 4% of the account balance. If that exceeds your income needs in retirement, then pat yourself on the back and start using these strategies to reduce your RMD liability. Most people begin using these strategies at age 59.5, though with a rule of 55, you could start that a few years earlier. Those are generally the sweet spot years where you can control your income because you're pulling money out of accounts like IRAs, 401ks, things like that. So you can keep your taxable income pretty low, making it easier to make conversions, move money around, do things like that to reduce the amount you'll owe in RMDs. We've got loads more on our YouTube channel about RMDs, IRAs, 401ks, pretty much anything investment related. There's also our website, markmoney.com. We'd encourage you to check that out. As always, we're grateful for your time and for watching our video. God bless and take care.